its failure to stabilize the Kenyan shilling despite the signing of the deal last year. In a report released by the International Monetary Fund, the government concedes that it has been unable to counter the free fall of the Kenyan shilling against foreign currency, facing pressure in the international market. And as Elizabeth Mutuku now reports, Kenya is now left with only two options: an honorable exit or the formulation of a strategic plan for departure. Have a look.
The G2G oil deal was signed last year, the government hailing it as the successful plan to shield the Kenyan shilling from free fall. The Energy and Petroleum Regulatory Authority, EPRA, emphasizing that the initiative had safeguarded the economy by eliminating spot purchases of the dollar by around 100 oil marketing companies.
Still possible to subsidize until, of course, we had some covenants with IMF. But suddenly the pain is heavy. It's not going to be easy. But luckily, because of our G2G, we have been able to go back to, in the last 2 weeks when we noticed the trend was going off.
However, the deal faced controversy, with former Prime Minister Raila Odinga demanding the resignation and prosecution of Energy and Petroleum CS Davis Chirchir and his National Treasury counterpart Njuguna Ndung'u, raising doubts on whether it was a government deal or just a few companies which were involved in the deal.
Tulisema punda imechoka. Leo tunasema punda imeanguka.
Months later, an International Monetary Fund (IMF) report has revealed that the Kenyan government admitted to planning an exit from the G2G oil deal due to failure to stabilize the Kenyan shilling against foreign currencies. Experts attribute this current taxation on fuel imports resulting in decreased oil imports volumes. This suggests that the fuel consumption in the country might be lower than anticipated. The IMF report further acknowledged distortions in the foreign exchange market, in the increase in rollover risk for private sector financing facilities supporting it, and a commitment to private market solutions in the energy market. Kenya is now faced with two options: a strategic exit or a dishonorable termination of the deal. Despite of the challenges, the IMF says that a large share of the increase between March and September 2023 could be attributed to escrow deposits under the oil deal import scheme. Expectations of the continued shilling depreciation amid persistent foreign exchange shortages and market dysfunction are also factors contributing to the decision to reassess the G2G oil deal. Elizabeth Mutuku, TV47, Nairobi.